See this. You have a control transaction. This is an M&E group. AE1 and AE2 are two M&Es of this M&E group. They have a control transaction in which AE1 licenses a patent to AE2 and AE2 pays a royalty back to AE1 transaction, right? Then you have a comparable transaction between two independent entities, independent party 1 and 2, jurisdiction 1 and 2, similar patent, license, similar royalty received from independent party. Obviously, this is an example of an external comparable, right? And in this situation, you find that the independent party 1 receives a royalty of say $120. $120, fine. In this case, here AE1 receives a royalty of say $100. And I have told you that let us assume that the patent which is being licensed and the patent which is being licensed here, they are comparable. Not some unique for which you require a PSM. Don't get into that. We have a normal patent which can be seen in independent parties, the transaction between independent parties. So this is the case. So similar patent. So here the royalty that is getting received, that independent party 1 is receiving, the licensor is 120, and here the royalty that is being received is only 100. Obviously, tax authorities of jurisdiction 1, they will examine this. When they examine this, so they also have comparables with them. Fine. And then they find that this is only 100 and this is 120, and then they undertake comparability analysis and they find that conditions are very, very similar. They share this information with the AE2, and AE2, I mean, it provides some explanation, but then tax authorities are not convinced. They say that because this patent is similar, that is why here you should have 120. Here you should have 120 because here you have 120. And that is why they make an upward adjustment of $20 here. That is plus 20. Because in their view, in the view of the tax authorities, because of the special conditions existing between these two AEs, this $20 should have accrued to AE1, but because of the special conditions, this $20 did not accrue. So now I will make the adjustment and I will add plus 20 here. You would remember that this sort of an example I gave when I was explaining to you article 9 in the very first class. Yes or no? Arvind, Aviral, Chetna, Kiran, Raghu and Vaibhav. Yes or no? Is the example clear? What is happening? Arvind, Aviral, Kiran, Raghu, Vaibhav. Everyone, please, quickly.
Yes, Manoj.
Right?
Yes.
Right. So this is article 9.1. This is article 9.1 because Article 9.1 says what? Because the conditions in this case are different from the conditions that would have existed between independent parties, and because of those special conditions, this 20 did not accrue. So therefore, now the tax authorities will add plus 20. Fine. Now, this addition of plus 20 to this 100, this is known as primary adjustment. This is known as primary adjustment. So this plus 20 that is being added now is primary adjustment. Primary adjustment. And primary adjustment is as per the operation of arm's length principle in Article 9.1. But if you add plus 20 here, there has to be consistency. If you add plus 20 here, there has to be what? Minus 20 here. Okay. Minus 20. Because only then you will achieve consistency. Plus 20 here, minus 20 here. Now, if AE2 or the tax authorities, if the tax authorities of 2 agree, that okay, plus 20 that you have added, plus 20 that one has added, that is for the operation, that is for the application of the arm's length principle. That is why I allow you, AE2, to decrease your profits remuneration by decrease the profit by 20. If 2 agrees, then everyone in this picture, everyone in this scene is happy. Fine. And if 2 agrees and AE2 does this minus 20, then this is known as corresponding adjustment. This minus 20, which is allowed by which is allowed by tax authorities of 2, which is allowed. Why it is allowed? Because tax authorities of 2 feel that this plus 20, which is being added by tax authorities of 1, this is for the proper application of the arm's length principle. So that is why I am allowing this minus 20. So if this is done, then this minus 20 is known as corresponding adjustment. Why corresponding? Because this minus 20 is corresponding to this plus 20. Right? So this is corresponding adjustment. Corresponding adjustment under Article 9.2.